Good morning and welcome to MarketCast 11. It's British summertime. I'm looking out of the window here in Bournemouth and I'm thinking to myself, yeah, really? So apologies for the weather, now we're in British summertime, and apologies of course for the outrageous shirt. I had a choice of 3 this morning and didn't have time to put it out to a poll, so I chose the most conservative. It was suggested to me by one of the production team here this morning at the AF Oliver offices in Bournemouth that I should have worn a Rod Stewart wig to go with it, but I think probably what we'll do is we'll just focus on the job in hand. And of course, as we said, today it's the budget special. Yes, Jeremy Hunt, bless him, stepped up on March 15 to present to us the budget. And I set myself, I thought, well, obviously, people are going to be waiting for comment about how the budget affects the housing market. So I set myself an hour aside on budget day to do a full analysis of all the measures that Jeremy Hunt took that are going to affect us in the house building industry. And here's the thing, I finished that analysis and then I had a little bit of time left over. And so I produced this. This is a jigsaw, 42,000 pieces, and I put that together in the little bit of the hour that I had left after I analysed the budget steps. All joking aside, as far as I can see, that right now is the only time in my working life that there have been no measures in place from the government to support any sector of the house building industry or the home buying public. And that really came as quite a shock to me. This is not a political webcast and I'm not going to go into the politics, but I know that many of you in the audience are members of the industry and you will know only too well how disappointing that is. But anyway, jigsaws aside and on to the matter in hand. So where were we when we looked at Budget Cast 10? Where were we? We had the mini budget mayhem. We had this going on, didn't we? This collapse in mortgage approvals and the withdrawal of thousands of mortgage products that meant that in Q4 last year, Q4 2022, people simply couldn't get mortgages. The market was artificially suppressed and we had mortgage approvals falling off a cliff, and it will be a little while before we actually see those numbers come out of the figures as well. So expect to see them just exactly the way they are. But what is fascinating and what was really concerning was how everybody reacted to this. All the mortgages are taken away. They're literally wiped off the market. If you remember what actually happened, the following day after that September mini budget, Kwasi Kwarteng's mini budget, they just shut down. The institutions just shut down. Interest rates were rocketing. There were all sorts of issues going on and people couldn't borrow money. So this came as no surprise to me. But as far as I was concerned, it was simply a sideshow. So what was going on in that microcosm of time in that last quarter 2022, and of course the hangover that goes with that into the first couple of months of 2023, were a complete sideshow that actually took our eyes off the ball of the way that the market was really moving. You can see that for the latest numbers that we've got so far, we don't have the January numbers yet, the latest numbers we've got so far, house purchase mortgage approvals down to under 36,000 and the world went crazy. Do you remember I showed you some of these stories? And what I thought was great is I just picked these words at random out of the headlines that were running in January and even last month. Prices were going to plunge. I love that, the word plunge. It's a very Guardian sort of word, isn't it? The plunge. In the Telegraph, they felt that prices were going to nosedive. And even in Property Industry Eye, they had somebody on there that was talking about volumes, Paul Smith, talking about volumes in the Property Industry Eye, and he said that volumes were going to plummet. So we were having prices plunging, prices nosediving and volumes plummeting. And there was I in last month's MarketCast saying, well, actually, I think there'll be an uptick in February and March. Hey, You heard it here first. So that's where we were. That's what the press was saying. This is where volumes were going, and you can see now that the green line here, which is the non-seasonally adjusted total here, plunging and plummeting and coming down. And of course, everyone was missing the point. They were absolutely missing the point that this was an artificial suppression of the market. One of those dips, it's like, I remember that when we were sort of halfway through the pandemic and just after all the lockdowns, and we were looking at the nationwide numbers, and I literally just took out the dips of the two major lockdowns, because it is not a true reflection of how the market is actually moving or the way the market is trending. So the whole point about this MarketCast is that we are looking forward to what's going to happen through the rest of this year. So forget the blips that are caused by things that went on. What we need to do is identify genuinely the way the market is moving and where it's going to move. Picked up the Property Mark survey this month, which I really like. 147 members of Property Mark contributed to this survey. And importantly, the survey was done between the 1st and the 13th of March. So bear in mind then, so this was pre-budget, and of course it was pre-interest rate rise, which didn't happen till March 24, till last week. So we need to bear that in mind. But having said that and picking some of these big items out of there, 141%, so quite a big, half as many again, increase in new prospective buyers in this survey carried out at the beginning of March. 39% increase in the stock of homes available for sale since February. I think that is really important too. The Property Mark survey touches quite a bit on the lettings market. Now, in these MarketCasts up until now, we've never really discussed the lettings market. It's interesting, isn't it, that the BBC today on Radio 4 have got a whole day on the rental market, on the heat in the rental market. And although this isn't about lettings and about rental, and this is all about sales and volumes, it is important because obviously the rental market impacts the resale market and the new home sales market too. So we'll just refer a little bit to the rental market as we go through. But my favourite chart in the Property Mark deck is this one. I think this is absolutely wonderful data here and so beautifully set out. This, if ever you want to see a trend and the way the market's moving, take a look at this chart. So what they do is they set out, this is 100% of prices achieved for sales made during the period from February 22 up to February 23. So the last 12 months up to the end of last month. And they ask their agents whether, and this is in the grey here, whether these sales were achieved for less than the asking price, in the orange here, achieved for at asking price, and in the blue here, achieved over asking price. That's a rare thing, isn't it? We only see that in those incredible markets that come up probably once every 15 or even 20 years. Look at that as a microcosm of where this market, people talk a lot of tosh, don't they, about where the market's been and where the market's going and what happened in the last quarter of last year. If you want a really good snapshot of where we've been, where the transition genuinely started, have a look at this. So here are the sales of these 147 agents, or however many there were that got involved in these surveys through the year. And you can see that right back in February, very few, less than 20% of sales were actually sold below asking price. And that came March 22. This was really the pinnacle of that red hot 2021 market. And as I have been saying consistently on these MarketCasts, the transition started around April. And this just pictures it perfectly for you. Look at the grey as we come out of April. Forget what happened in September, October, November. I know it's easy for me to say that and not so easy for you to do that when you need reservations on a weekly basis, particularly through that last quarter. But just look at how it's trending. And interestingly, have a little look down here. Look, so this blue bit, if you remember, this blue bit are for deals that were done above asking price. And here we got all the way down here. And isn't that interesting how they are starting to climb out of there, just saying to us that there is this pulse, there is this blip, a blip and a pulse that I absolutely predicted, not just in the last MarketCast, but the one right back at the back end of last year. So this is a lovely demonstration of where the trend really is. Obviously, the clever money, the smart money is going to be where the trend is really going, but that gives you a great idea of how this market has been performing, wiping away all the bells and whistles and fripperies. That's the real thing. We talked last time round, didn't we, about this market changing from an aspirational, a wants-based market into a needs-based market. And that is why we had this pulse, because that market had already transitioned. We'd gone through April, May, June, July, August. The market was already moving that way. Interest rates were already starting to creep up. People were talking about interest rates going up. We already had the conflict in Ukraine. We had rampant inflation going on. So all of those things were happening. Consumer confidence was coming down really rapidly. And so the people that were just moving because, hey, guess how much we can get for our property? And wouldn't it be nice if we lived up on top of the hill? That market then got smaller and smaller and smaller. But the needs-based market, the people that have to move, the people that are getting divorced or have got a new baby or moving there with their job, that still exists. And the whole point is that if you take mortgages away from those people for 3 months at the back end of a year, those people aren't going to stop needing those properties. So when the mortgage products become available again, then they will come back to the market. And if they're in the needs-based part of that category, the fact that their mortgage is now 4.75% or 5.25%, they will price that in. And bear in mind, since 2013, most domestic mortgages have actually been stress tested up to 7%, which is why we're in such a different position this time round to where we were in 2008, 2009. I need to be careful. I'm getting to sound more and more like Boris Johnson. I'm getting excited. That's the idea for the next week, for goodness sake. Okay, so that's happened. That's where we were and what worked. So what about what's happened since we last met on the last MarketCast in February? Well, this one, we can't get everything right. This one caught me out. And I remember saying at the last MarketCast, inflation is going to continue to fall. The government have already come out, haven't they, and said that inflation will be half what it was at the end of the year. It will be half that at the end of this year. I still absolutely believe inflation is going to fall, but make no bones about it. When these February numbers came out, they caught everybody out. You can see that little blip up there, can't you, on the end there? So inflation, the CPI inflation went from 10.1 to 10.4%, catching us all out. We all thought it was going to drop down into single figures. And of course, the measure that I prefer, which is the CPIH measure of inflation, which is the consumer price index, but with home owner costs on there as well. Well, that also went up, didn't get into double figures. That went up from 8.8% to 9.2%. So you can see where these numbers here are here. Back in double digits for the CPI at 10.4, CPIH at 9.2. It was a surprise. I would be prepared to stake a fairly substantial wager that when we see the numbers come out for March, and we're not going to see those obviously for a few weeks yet, but when we do, that the CPI will be back down into single figures and we will then go back then on this downward trajectory. As somebody quite rightly pointed out just last week, the fact that the numbers are coming down doesn't mean prices are falling. They are still rising, but they're not rising quite so quickly. So we had that unexpected jump up in inflation. And of course, immediately after those numbers came out, literally, I think 2 days, was it, later, the MPC met and pretty much everybody knew that they were going to raise rates. And they did, 25 basis points. So they raised them from 4 to 4.25%. If you remember, the Fed in the US had just raised theirs, I think, by 50 basis points a couple of days previous. So they had the Fed numbers going up. They had a very unexpected blip upwards in inflation. There was nowhere else they were going to go. At one point, there were even some siren voices saying, let's raise them 50 basis points. I think in the end, the vote was 2-7. So there were 2 doves and 7 hawks on that committee. I personally take the view that that increase was already baked in. I think the industry knew it was coming. I don't think it is going to make a huge amount of difference. It will probably affect consumer confidence a little bit. We're going to look at consumer confidence today. I'm not going to skip over that today because that's important. But the thing is about the latest data from GfK is it was collected in the 2 weeks at the start of March. So it was collected before this interest rate increase happened. But I think everybody sort of knew. I think we all feel, certainly I felt, and I still feel, that we may well get to 4.5 on base before we actually start to see that fall. That is slightly complicated by the unsettled nature of the financial industry at the moment. Had a couple of banks go in the States, haven't we? And so there, and issues with Credit Suisse, and so there are some issues there, and I think that just actually calms everything down. I think in the UK we may well see it go to 4.5, but I think that's as high as it's going to go in this cycle. But so looking at this and looking at that, and you think, oh my word, it's no wonder this is having an effect on the housing market. When you look at it in the round and you look at it like this, that changes things then, doesn't it? Because here was the financial crash and the crisis in 2008, 2009, and that's what happened with interest rates, because the economy was on the floor. So it was literally in meltdown, and it was all about recovery. So interest rates were taken down to historical lows and kept there for an extraordinary amount of time, and taken even lower when COVID bit here in 2020. So we knew that wasn't going to be the case forever. Even if we fooled ourselves, because there are a lot of years in there, we're talking 15 years worth of incredibly low interest rates. I've got to say, when I put this chart together yesterday evening, I wanted to just take a look at how it measured up historically in terms of interest rate changes. I was amazed how long that had actually been in place. But if you take that out as the gap in between now and a huge catastrophic financial crash, this is where we were before. This is where we were before. At the 4s and 5s and 6s, you'll find lots of people my age telling younger people, I remember in 1990, and interest rates went up to 3,000%, and we had to go down to the building society with a wheelbarrow full of money. It's amazing how memories tend to actually change themselves as the years go on. The fact of the matter is, the market naturally tends to balance itself in terms of its price and its interest rates. So I'll show you what I mean. But this, I think, is the unusual part. When you look back on the Bank of England website, you can go all the way back and look at interest rates pretty much since the start. This is the norm. This is really the norm. Those crazy 15, 16%ers are outrageous to address a specific issue. And these zeros and 0.5s and 0.25s, they're equally outrageous to address an issue. We're back to the norm. This is where we're going. This is why I can't quite understand why people react the way they do. And this is nationwide numbers. So nationwide numbers are always a bit tricky on the MarketCast because they tend to come out a few days afterwards. But these were the last ones at the end of February. Look at these. This is the UK house price to earnings ratio. So how much, what multiple of average earnings does the average house cost? The long run average, you can see, sits just fractionally above 4.5 times. And you can see then in this extraordinary period here up to 2008, when the building societies, do you remember, they were lending 110% of the value of your property. Now, you want to talk about an inflation fueler? I mean, that's just crazy, isn't it? You think about it now, people talk about meltdown and repossessions and so on, and you think what the lead up to 2008 was like with that sort of monetary policy and those sort of policies in the building societies, and they were buying crazy financial products. Remember CDOs, collateralized debt obligations. My word, they were buying all this stuff, weren't they, from the US banks? And it was an extraordinary time. So that took us all the way up there. And of course, then we crashed down here in the crash, down towards this long run average. And it's been climbing since. And we've had this inflation in the market since, and it's been very, very strong. Under supply, over demand. Look at this. This is what happens. So as the interest rates step up, prices then come down to meet it. And we will eventually run along this long-term average. And because you can go back a long way, I mean, even the nationwide numbers go back to 1983, and you can see that that is the way the market actually works. That's the way the market's going to work. So we've had interest rate rises, all of that stuff, mortgage products taken off the market, and yet, look, this is the March Rightmove index that's blipped up by 0.8%. And I know there will be people listening to this who say, but hang on a minute, normally in March it goes up by 1.8% or whatever the average is for March. So it is low for March, but it is still an increase. So these are asking prices. So there are people out there that have gone through that last quarter of 2022 and that have still put their prices up. It's bizarre but true. And it's not just the Rightmove either. This was the Halifax, and of course the Halifax is from achieved prices. So Rightmove are asking prices, that's one thing, flying a kite and so on. But for their February numbers, the Halifax went up 1.1%. This gives you some sense of the reality of this spring or March blip, as I call it. We looked at these numbers last month, if you remember, because the Zoopla numbers literally came out on the day that we broadcast MarketCast in Feb. But you can see where we are with that, with the Zoopla saying that there'd been that the annual rate of increase was still at 5.3%. But this discount to asking price, interestingly, and that takes us all the way back to that property market chart that I showed you. Look at how consumer confidence is wearing up. Next month's GfK chart will be really important to us. Now, I cannot understate how important the way the public feel about the economy and about their own personal finances is when we're thinking about the way the housing market's going to move. We are all trying to future gaze. We are all getting our crystal ball out to a certain extent. This is a really important constituent part of that crystal ball gazing. And when you look at this pit here, which is just immediately after the Truss Quarteng magnum opus, as I like to call it, this is where we got down to record lows in the 50 odd years that this survey has been running. And so don't forget, those of you not seen this before, zero is up here. So all of these lines on this chart are in negative. So when people say, how are your personal finances going to be next year, better or worse? The balance is still worse. The green line, what's the climate for? Is it a good time to make a major purchase or a bad time? The balance from the red line look down is still in negative. So the balance is worse. And this red line here, of course, is the overall index. And you can see that's still very low, still well in negative. And then, of course, the UK economy, how do you think that's going to go over the next 12 months? You can see it's still deeply in negative. But look at the trend. Look at the trend. And there is a stoicism in our market. There is a stoicism in the British public, in our target audience, that says, okay, this is pretty crap. This is pretty crap, but I'm actually going to go with this, and now I need to move. The baby isn't going to wait for an interest rate reduction. It's on its way. We are going to buy a house. And this is coming up. Be fascinating to see next month, because then next month we'll have the interest rate rise and the budget data. But please bear in mind, when you think about interest rate rises, for these last 5 months, before every single one of these surveys were carried out, there'd been an interest rate rise. That is such an important piece of data. Sellers are getting real. These are the Zoopla numbers. We looked at these last month, so I won't dwell on them. But here's that 4.5% discount to asking price. It amounts on an average price of up to about 14K on average, which is just about a third of the gains that the people made across the, the extraordinary market from 20 through to 2022. And I stress this. This is so important for particularly the mainstream media. If anyone in the media is watching this, have a look at this, because forget stock here, although that is important because it's still 11% less than it was pre-COVID. Have a look at here. So number of sales agreed. At first glance, if you look at the data, the number of sales agreed is down 24%. But if you compare it to pre-COVID, it's higher than it was pre-COVID. And I find it bizarre the way the British press just search for the bad news and report that. Let's be realistic. It is going to be difficult. And there is no question that when we come through this spring blip, we are going to have a tricky summer. Nobody's dodging that, but let's be realistic rather than sensational about it. These are interest rates, or these are average mortgage rates collected by the Bank of England, a basket of mortgage rates, which they then present as an average. It's a great way of looking at how mortgage rates are going to go. So these are across a 2-year fixed term at different loans to value. Obviously, the top one here being 95%, down to 60% here in the light blue. You don't need me to dwell on this. You can see where the trend's going. And when you look at the a fixed rate, a 75% loan to value mortgage across the different fixed terms, it's easy to get twisted around with this. So 2-year up to 5-year, you can see where this money's going. The long-term money is getting cheaper. These guys know what they're talking about. You can see there, this is the latest money we had, the data we had at the end of February, 28th of February data, and the 5-year 75 loan to value is down under 4.5%. There you go. So despite the interest rate rise. Okay, we've got a couple of minutes left now to take a look at where we're going next in 2023. I'm feeling, this is a crazy thing to say, isn't it? I'm feeling more confident that I've got a sense of where this market is going over the rest of this year than I have done for a long time. I feel I've got a handle on how the market is feeling. This market factor matrix is, it's where I start. When I'm putting this together, I take all these little boxes that affect the way that people feel and people think and the plans they make about the market, and I reposition them. So I take a look at what's happened in the month and I say, yeah, actually that's now not an issue anymore. So if you look at one of the most damaging ones, mortgage availability, the one that did all the damage after the mini budget last September, that if you look at the MarketCast at the end of September, that was up here. It was having a massive effect on the market, and that has been sliding back ever since. It's still very much negative because it has a hugely damaging effect, but mortgage availability now is really good. The institutions now are competitive. They want your business. So I get this and I look at what's going on. I look at the good stuff like the low supply, high demand. That's been sliding back. We knew that. Stamp duty changes are still there and important, but they're going back a bit in people's psyche here. The national insurance allowance here, that's sliding back as well because that's coming out of people's everyday thinking. But the high mortgage rates are important. Low consumer confidence, I've just shown you that chart, that's sliding back too, as is affordability. Do you remember we just looked at that nationwide chart? So all of these things change position every time I look at them, and I look at those to build myself up the best possible picture of the way the market's going to move. Okay, we've seen this dip in volumes. I showed you this slide a little while ago, but I thought it was important to put it back on again. When you look at the seasonally adjusted numbers, they're fine, they're fine. Last year, we were almost 1.3 million. I am still convinced, despite everything, what was his name? Paul Smith. Volumes are going to plummet. They're not going to plummet. They're not going to plummet. I stake my reputation on it. Volumes will be between 1 and 1.1 million this year. Of that, I'm absolutely confident. Looking at estate agent stocks, these are the right move, latest numbers in February. These are now starting to build back out again. And, so we're seeing More stock available on the market. I've got property mark numbers on those too. And I call this the buyer's return. Don't want anyone out there thinking I've missed an apostrophe, okay? That's not like the rover's return. It doesn't need an apostrophe. It's saying the buyers are returning. The buyers are returning. This is another one of these great charts on the property mark survey. And you can see here, look, this is December here. So here's our quasi-quarteng moment. And that's where we went. And this is where we are. I stress that in better markets, in better years, they would be higher still. But the point is, the trend there is absolutely evident. So where does that leave us and where are we going to go? The dark blue ones here then are actualities. And as you know, those of you that watch this regularly, you'll know that I base my forecast on the nationwide index. It's a big cheat for even some of the biggest and best known agents, market commentators, that they don't actually say which index that they're basing their forecast against, because then you can dodge pretty much anything because they range like that. So this is the nationwide. Here's January, here's February. February, I'm sure you know, went to minus 1.1. I'm thinking that when the numbers come out in a few days' time in March, even though that will still be in negative in March, the actual average price will have blipped up. I've not changed that forecast. That is, I have always seen that that's going to be the case. And I think we are going to see that average price continue that trend right through to the end of spring. It's going to go to April, May. What's the phrase I'm looking for? Make hay while sun shines? I might be going a bit too far there, but it does give us an opportunity to take advantage of those market conditions. And then I do think we're going to see that come down. And I actually have got a little more pessimistic about the summer. I think that there will be a stronger decline in summer than I originally saw. I saw this as a much smoother rundown to minus 4% at the end of the year, which I still believe is where we're going to be. I just think one or two of the signs that I've seen suggest to me that once this pulse has gone through, I'm sure there is a pulse happening right now. So the pulse, the people that couldn't buy in the last quarter of last year go through, and so we lose that pulse, then I think we're going to feel that in the market, but perhaps only in the short term. I think we're going to have quite a difficult July and August, if I'm going to be honest. But then I think we will see an uptick again. That's me predicting another one, you mad fool, in September, before we start naturally to run down in towards the end of the year. That is how I see prices going. And like I say, I'm feeling quite bullish and confident about that. I keep telling you, the lines on this chart are going to come closer together. They are going to converge. They're not doing it yet. Last time, I think I showed you this slide. That was 38%. Please bear in mind, this is the ONS. This is land registry numbers. So these are old numbers. They're October. When I say they're old, they're the latest I can get, and they literally have only just been published. But nevertheless, they are last October. So just bear that in mind. But right now, shockingly, the new homes premium is sitting at a whopping great 44% according to the land registry on average. That cannot sustain. And that will obviously have an effect on new homes prices as against second-hand home prices. Just running a tiny bit over last slide. Then in summary, look, we've transitioned, haven't we? We've gone from this wants-based market to the needs-based market. Please bear in mind right now, the lettings market is absolutely red hot. It really is important. That mortgage hiatus artificially suppressed the market in the back end of the quarter. And then this blip that we're actually seeing is the result. I think that most commentators now have realized that they were quick to rush to the disaster zone and they believe that the market won't crash. I do think we need to be thinking about the fact that Help to Buy has now gone. If you think about it, it's an extraordinary thing, probably the most successful aid for property buyers, certainly in my living memory, that's for sure. During the 10 years, from April 2013 up until last year, the back end of last year, 375,000 people used Help to Buy their new home. It's an extraordinary number. And if you think about it, that the government loan part of that was over 24 billion. And if you want a really big number with Help to Buy, the total value of the property that was bought using Help to Buy as an enabler was over £105 billion. You cannot take that out of the market and then expect that it won't have an effect. It will. And that just means that people, particularly the developers, have to work very, very hard to find ways to enable first-time buyers, particularly to buy now. So that really is a thing. The spring market I've been talking about for ages is now a real thing. I don't think anybody can doubt that, can they? New homes values on average, I still think those lines are going to converge. I nearly took that out this month, but I'm still convinced that that's actually going to be the case. And I'm thinking that we will end 2023 minus 4%, but I think we're going to have a difficult summer. I think we'll see a sharper dip in summer before we see an autumn resurgence and then a drop to around minus 4%. And we will see volumes between 1 and 1 million. I am convinced that that is correct. And I think that the new home share of the overall market will be about 12.5%. There you have it. And okay, we're 5 minutes over. We did so well last month, didn't we? We finished bang on time. The next MarketCast is on Thursday, the 27th of April. And guess what? We're planning a new format. We've got something really interesting to actually present to you on the 27th of April, probably from our London office rather than from I was going to call it sunny South Coast. Thank you for those of you that have managed to stay to the end. It's wonderful. Look forward to seeing you in April. In the meantime, enjoy the springtime. Thanks. Bye.